What explains the rupee's depreciation? What does it mean for the average Indian citizen? How does the rupee trade work? How will it impact India's trade relations? In today's discussion, we will have a detailed look at the issue of the sliding Indian rupee and measures to arrest the same. The Indian rupee has plunged to a new low against the US dollar, depreciating 7% since the start of the year and even breached 80 against the US dollar. Foreign portfolio investors have pulled out 2.32 lakh crores in 6 months. India's forex reserves over the last 9 months have decreased by $50 billion to $593.3 billion. Since the Russian invasion, the rupee has depreciated about 4%, while currencies in other emerging markets have depreciated 4 to 7%. This is due to factors such as the US Federal Reserve's interest rate hike, an outflow of foreign funds from Indian stock markets, and so on and so forth. The currency slide is causing problems for policymakers and a number of businesses too. Amongst a slew of other measures, the RBI has rolled out a system to settle international trade transactions in the Indian rupee instead of dollars. Let us have a look at the causes of why the Indian rupee is depreciating. In a free market economy, the exchange rate is decided by the supply and demand for rupees and dollars. In case Indians demand more dollars in comparison to Americans demanding the rupee, the exchange rate will fall or weaken for the rupee and rise or strengthen for the dollar. The US Federal Bank rate hike leads to dollars moving out of India. The Federal Reserve System is the central bank of the United States. Interest rate hike by the US results in foreign institutional investors pulling out from Indian stock markets, as Indian markets would be far less attractive to them. An increase in interest rates would result in a weaker Indian rupee in comparison to the US dollars. Rising import costs. The Brent crude oil prices have reached to 14-year highs. India meets 80% of her crude oil requirements through imports. Hence, this leads to a rise in import costs, which in turn weakens the rupee. This is because India's demand for dollars would have increased while global demand for the rupee remains unchanged. Rising current account deficit. A current account deficit occurs when the total value of goods and services a country imports exceeds the total value of goods and services it exports. The current account deficit for India in the fiscal 2021-22 has come in at 1.2%. A huge current account gap could make the rupee depreciate further in the absence of meaningful intervention from RBI. What are the advantages and disadvantages of rupee depreciation? First, let us have a look at advantages. Exports become cheaper and more competitive to foreign buyers. Therefore, it provides a boost for domestic demand and could lead to job creation in the export sector. Higher level of exports should lead to an improvement in the current account deficit. This is important if the country has a large current account deficit due to lack of competitiveness. A weak currency could help foreign investment through secondary or primary markets, as a strong dollar would give the investor more rupees in his hand and thus an opportunity to buy more shares. The domestic products which get competition from imported products gets an indirect advantage as imports get costlier, which gives local product a cost benefit. A number of Indian companies have a sizable international presence apart from direct exports. A strong foreign currency helps boost their consolidated numbers. Let us have a look at the disadvantages. India being the third largest oil importing country, it could have an adverse impact of currency depreciation. Rising imports will increase the current account deficit. Currency depreciation could lead to inflation as the cost of imported goods would go up. For example, rising fuel prices would push prices of commodities higher. Students looking to study abroad will be severely hit as they will have to shell out more rupees to meet the costs. It affects those companies who have raised debt abroad and have not been fully able to reap benefits. Let us have a look at the measures which have been taken by the RBI. To make up for the multi-billion-dollar outflow due to selling by foreign portfolio investors and a record trade deficit, the RBI has taken steps to boost debt inflows. It has sought to boost debt portfolio inflows by widening the basket of securities available to foreign portfolio investors. Foreign portfolio investing is a route for foreign investment in India. It started in 1992 as India opened up its economy and allowed the investment in its domestic stock market. It includes investment in shares of listed Indian company, non-convertible debentures, units of domestic mutual funds, government securities, security receipts, etc. Foreign portfolio investment in India are regulated by the SEBI. As a temporary measure to attract capital, the RBI has allowed banks to give higher returns on foreign currency deposits on which they will not have to maintain any reserves. Rules governing external commercial borrowing for corporates have been relaxed, with the automatic route being doubled to $1.5 billion and the cap on borrowing costs raised by 1 percentage point. External commercial borrowings are loans in India made by non-resident lenders in foreign currency to Indian borrowers. They are widely used in India to facilitate access to foreign money by Indian corporations and public sector undertakings. Non-resident Indians will get higher returns for bringing foreign exchange into India into FCNR B and NRE deposits, as the cap on rates has been removed for fresh deposits. FCNR B are foreign currency non-resident deposits denominated in foreign currency, while NRE deposits are non-resident external deposits. In the past, such deposits have attracted billions when rates were raised during capital outflows, as foreign banks are happy to extend personal loans to NRIs who then park the money in foreign currency deposits at a higher rate. The Union government has also increased export taxes on oil and petroleum products and import duty on gold to control the widening current account deficit. The Reserve Bank of India has rolled out a system to settle international trade transactions in the Indian rupee instead of the dollar. This is aimed at promoting the growth of global trade with emphasis on exports from India and to support the increasing interest of the global trading community in Indian rupees. It is envisaged to help carry out trade with nations which are out of the SWIFT system, like the nations which are under global sanctions. It may add strength to rupee in forex trade. A greater global trade share for the rupee will help the central bank preserve its foreign exchange stockpile. However, the critical part will be the denomination of the exchange rate that will be decided by the market. For settlement of trade transactions with any country, banks in India may open special rupee vostro accounts of correspondent banks of the partner trading country. The rupee surplus balance may be used for permissible capital and current account transactions in accordance with mutual agreement. The balance in special vostro accounts can be used for payment for projects and investments and for export or import advance flow management. The local trade will fall out of the ambit of forex movement, and this will benefit India at a time when forex reserves are under severe pressure. It is also expected to narrow the trade deficit. This is the first step towards 100% convertibility of the rupee. The exchange rate between the currencies of the two trading partner countries may be market determined. The government also requires to clarify on export benefits of such exports in rupee, which was earlier being granted only for export payments received in foreign currency. Let us have a look at convertibility. Convertibility is the ease with which a country's currency can be converted into gold or any other currency through global exchanges. Currency convertibility is an important part of global commerce because it opens up trade with other countries. Having a convertible currency allows a government to pay for goods and service in a currency that may not be the buyer's own. Having a non-convertible currency makes it harder for a government to participate in the international market because these transactions generally take longer to execute. A nation's economy may be related to whether its currency is convertible or not. Stronger currencies tend to be converted more easily than others, while growth may be stagnant for countries with poor convertibility because these countries may miss out on trade opportunities. What are the two types of currency convertibility? Current account convertibility and capital account convertibility. Any currency may be current account or capital account convertible or both. Current account convertibility implies that the Indian rupee can be converted to any foreign currency at existing market rates for trade purposes for any amount. It allows for easy financial transactions for the export and import of goods and services. Any individual involved in trade can get foreign currency converted at designated banks or dealers. In essence, current account convertibility remains within the institutional trading realms. At the beginning of the reforms, the rupee was made partially convertible for goods, services and merchandise only. During the mid 1990s, the rupee was fully made current account convertible for all trading activities, remittances and indivisibles. However, the rupee continues to remain capital account non-convertible. Capital account convertibility allows freedom to convert local financial assets into foreign financial assets and vice versa. It includes easy and unrestricted flow of capital for all purposes, which may include free movement of investment capital, dividend payments, interest payments, foreign direct investments in domestic projects and businesses, trading of overseas equities by local citizens and domestic equities by foreigners, foreign remittances, and the sale or purchase of immovable property globally. One can still bring in foreign capital or take out local money for these purposes, but there are ceilings imposed by the government that require approvals. Let us have a look at the advantages and the disadvantages of making the INR into a fully convertible currency. Sign of stable and mature markets. Regulators like to keep control over their territories. A free and open entry to an enormous number of global market participants would increase the risk of losing regulatory control due to the large market size and a huge flow of capital. Opening up to a fully convertible currency is a solid sign that a country and its markets are stable and mature enough to handle the free and unrestricted movement of capital, which attracts investments, making the economy better. Increased liquidity in financial markets. Full capital account convertibility opens up the country's markets to global players, including investors, businesses, and trade partners. This allows easy access to capital for different businesses and sectors, positively impacting a nation's economy. Improved employment and business opportunities. With increased participation from global players, new businesses, strategic partnerships, and direct investments flourish. It also helps in the creation of new employment opportunities across various industry sectors, as well as nurturing entrepreneurship for new businesses. Onshore rupee market development. The growing international interest in the Indian rupee is evident from the development of offshore rupee markets in locations like Dubai, London, New York, and Singapore. Trading of the Indian rupee is still far lower than other countries such as the euro. Making the rupee fully convertible would enable greater trades and global flow of the Indian currency, helping national markets with improved liquidity, better regulatory purview, and reduced dependence and risks from offshore market participants. Easy access to foreign capital. Local businesses can benefit from easy access to foreign loans at comparatively lower costs and lower interest rates. Indian companies currently have to take the American depository receipts or the global deposit receipts route to list on foreign exchanges. After full convertibility, they will be able to directly raise equity capital from overseas markets. Better access to a variety of goods and services. Amidst current restrictions, one does not see much variety in India for foreign goods and services. Full convertibility will open doors for all global players to the Indian market, making it more competitive and better for consumers and the economy alike. Progress in multiple industry sectors. Sectors like insurance, fertilizers, retail, etc. have restrictions on foreign direct investments. Full convertibility will open the doors of many big international players to invest in these sectors, enabling much needed reforms and bringing variety to the Indian masses. Outward investments. At present, any Indian individual or business would need permission from authorities to buy property abroad. After full convertibility, there will be no limits on the amounts exchanged and no need for approvals. Improved financial system. The Tarapur committee, which was tasked with assessing the full convertibility of the rupee, has noted these benefits after full convertibility of the rupee. Indian businesses will be able to issue foreign currency denominated debt to local Indian investors. Indian businesses will be able to hold foreign currency deposits in local Indian banks for capital requirements. Indian banks will be able to borrow and or lend to foreign banks in foreign currencies. Easy options to buy or sell gold freely will exist, and banks will be able to offer gold-based deposits and loans with higher limits. Let us have a look at the disadvantages. High volatility. Amidst a lack of suitable regulatory control and rates subject to open markets with a large number of global market participants, high levels of volatility, devaluation or inflation in forex rates may happen, challenging the country's economy. Foreign debt burden. Businesses can easily raise foreign debt, but they are prone to the risk of high repayments if exchange rates become unfavorable. Imagine an Indian business taking a US dollar loan at a rate of 4% compared to one available in India at 7%. However, if the US dollar appreciates against the Indian rupee, more rupees will be needed to get the same number of dollars, making the repayment costly. Effects on balance of trade and exports. A rising, unregulated rupee makes Indian exports less competitive in the international markets. Export-oriented economies like India and China prefer to keep their exchange rates lower to retain the low-cost advantage. Once the regulation on exchange prices go away, India risks losing its competitiveness in the international market. Lack of fundamentals. Full capital account convertibility has worked well in well-regulated nations that have a robust infrastructure in place. India's basic challenges, that is, a high dependence on exports, burgeoning population, corruption, socio-economic complexities, and challenges of bureaucracy, may lead to economic setbacks post full rupee convertibility. To conclude, while some countries like China have purposely depreciated their currency to gain the trade benefit, there are other nations where a weakening currency creates havoc. The multi-million dollar question is whether a weakening currency is an indication of something good or bad. It definitely is not a good sign for economies. A weak currency is often accompanied by a current account deficit and reflects a weakening economy. An aggressive international trade lobbying is required to actively promote rupee trade with dominant economies. On the other hand, we need to closely monitor the Indian exports. There are two dangers that we need to watch out for. First is the diversion of Indian exports from the international market to other countries, and second, re-exports from third countries through the rupee payment route. With outlook in Delhi dominated by the country's balance of payments problems, the advantage of paying for capital good imports in inconvertible rupees was thought to outweigh such losses. The overall benefit of rupee trade outweighs the negative factors in the long run. Also, to become a global trade player, the local currency should be the preferred trading instrument. India is expected to become a truly global economy in the near future, and it will need fuller integration into the global economic system. Making the rupee fully convertible is an expected step in that direction. How soon can India do this depends on many conditions being met, including low levels of non-performing assets, fiscal consolidation, optimum levels of forex reserves, control on inflation, manageable current account deficit, robust infrastructure for regulating financial markets, and efficient monitoring of financial organizations and businesses. Despite economic progress being made by India on many fronts, there have been many regular challenges at both the global and local levels, including the global financial crisis of 2008-2009, a lack of inflation control, and rising non-performing assets, all of which have delayed full convertibility of the rupee. India is rightfully resisting the vested interests of the US and Europe with regards to our foreign policy and trade. The rupee trade highlights our independence in foreign policy and seems to be a step in the right direction. With this, we have come to the end of our discussion on the slide of Indian rupee and the measures taken by RBI to mitigate the same. Please do let me know if you would like to know more about current affairs topics in the comment section. If you like the content, please do like, share and subscribe to my channel. All the best. Jai Hind.